Hey everyone, running a business in South Africa. Wow, it's a lot, right? So today, we're going to put together your essential starter kit for something that's, well, absolutely crucial, bookkeeping. Don't worry, we're going to make this super clear, super simple. Let's dive in.
Okay, let's just get straight to the point. The big, scary reason this all matters so much. This isn't just a nice to have or good business practice. Nope. Not keeping your financial records straight in South Africa? That's a criminal offense. We're talking serious stuff here. The stakes are incredibly high.
All right, I know that last slide might sound a bit terrifying, but hang on. The point isn't to scare you, I promise. It's actually the opposite. We want to empower you. We're going to break this whole thing down into easy, bite-sized steps so you know exactly where to begin.
First up, let's talk about what we're calling the non-negotiable rule. And yeah, that's exactly what it is. Think of this as the absolute foundation for everything else. Your financial health, your legal status, the whole shebang.
And the key word here is all. Seriously, it doesn't matter if you're a one-person show working from your couch or a team of 10. This law applies to absolutely everyone. No exceptions, no loopholes.
So who exactly are we talking about when we say all? Well, pretty much every business type you can think of. Are you a sole proprietor? You're on the list. In a partnership, you too. A registered private company, a nonprofit, or even a cooperative? Yep, this rule applies to all of you.
Okay, so step 1 is knowing the rule applies to you. Check. Now for step 2, figuring out exactly what kind of business you are. Why? Because your specific duties really depend on that structure.
This little table breaks it down perfectly. See, if you're a sole proprietor or in a partnership, things are a bit simpler. No need to register with the CIPC, that's the Companies and Intellectual Property Commission. You'll just handle your taxes through your personal income tax return, the ITR-12. But the moment you set up as a private company or a cooperative, things change. CIPC registration becomes a must, and you've got to file a separate corporate income tax return, the ITR-14. And for nonprofits, you also register, but you can get tax-exempt status as a public benefit organization or PBO.
And hey, for all you registered companies out there, listen up, because this is a big one. Good bookkeeping is what lets you file your annual return with the CIPC. If you miss that for 2 years in a row, poof, your company can be automatically deregistered. And trust me, that is a headache you do not want.
All right, so we've covered the why you have to do this and who has to do it. Now, let's get to the what. At its heart, it's all about tracking two things, the money coming in and the money going out.
Honestly, bookkeeping is basically just a story with two sides. On one side, you've got your debtors. That's all your income, the sales you make, the cash customers give you. On the other side, you've got your creditors. These are all your expenses, the bills you pay to keep the lights on, buy supplies, you name it. So, tracking that income, how do you do it? Simple. Create a paper trail for everything. That means keeping every single customer invoice. Here's a great tip. Number them one after the other, like INV0001, INV0002. It makes life so much easier. And don't you dare forget the small stuff. Cash sales, till slips, it all adds up and it's all income.
And guess what? It's the exact same story for your expenses. You need to keep every single piece of paper. The invoice for your rent, the bill for your stock, statements from suppliers, all of it. And yes, I'm talking about those tiny little cash slips for petrol or stationery, or even that coffee you bought for a client meeting. Every cent counts as a business expense, so track it.
So why are we so obsessed with these two lists? Because it all boils down to this one super simple but incredibly powerful formula. You take your total income, subtract your total expenses, and what you're left with is the most important number for your business, your profit or your loss. This is how you know if you're winning. Okay, so you've got a handle on income and expenses. Awesome. Now let's add the next layer to your financial picture. We're going to talk about the bank, any loans you might have, and your company's assets.
Listen, if you take away only one thing from this entire explainer, please let it be this. This is the golden rule, the number one commandment of business finance. You absolutely cannot, under any circumstances, mix your personal and your business money. It's a recipe for disaster.
So, how do you follow that golden rule? It's actually really simple. The very first thing you need to do, like right now if you haven't already, is open a separate bank account just for your business. All business money in, all business money out. It's the key to keeping things clean.
And once you have that separate account, it becomes the hub for all these other important documents you need to hang on to. We're talking your business bank statements, obviously, but also things like your car finance statements, any big loan agreements, and a list of all your business assets, laptops, machinery, that kind of thing. All right, our last section is about something that trips up a lot of new business owners: money and people. Specifically, how you pay them and how you pay yourself. This is probably the question I hear the most from new directors. You're pouring your heart and soul into this thing, it's starting to make money, so how do you actually take some of that money out for yourself the right way?
First off, you can't just dip into the cash register. That's a huge no-no. There are two main legal ways to do this. Option 1, you pay yourself a formal salary, just like an employee, and that means the company has to handle all the proper PAYE taxes. Option 2, you can take it as a shareholder loan, but, and this is a big but, that's a debt. You personally owe that money back to the company.
Now, there is a third way to get paid, but this one only happens if your company is doing really well. If you've got profit left over after paying all your taxes, you can choose to pay some of that profit out to the shareholders, and that payment is called a dividend.
So what's the deal with tax on those dividends? Well, it's a flat rate, 20%. That's the amount of tax you'll personally have to account for on any dividends you receive.
Look, at the end of the day, it doesn't matter if it's a salary, a loan, or a dividend. The big idea is this: good bookkeeping is you know exactly where every single rand is going. It protects you, and it protects your company.
And that really brings us to the final point. I know, it's so easy to think of bookkeeping as just a chore, right? A boring legal thing you have to do. But try to think of it differently. Your books? That's the real story of your business. It's the official record of all your hard work, your wins, your growth. So I'll just leave you with this one question to think about. Is your bookkeeping telling the true story of everything you've built?